Hello class, this is a video lecture for chapter 10, Accounting for Long-Term Liabilities. Well, I have here Mr. Bond because mostly we will be talking about bonds. And this chapter gets quite complicated for students, so I would like you to pay close attention and follow my examples. Of course, practice makes it perfect, and without practice one cannot really learn accounting. So chapter 9 we covered current liabilities. In chapter 10 we're covering long-term liabilities, debt that comes due in more than 1 year. There are many different types. Some examples include bonds, notes payable, such as mortgages or car loans, long-term notes payable, right? Any kind of loan you're taking that is maturing in more than a year is considered to be a long-term note payable. There are other examples such as leases, when we lease from somebody a building for more than a year based on our contract, or pensions. We're not going to cover those in this class. They're covered in higher level courses. So after chapter 10, you have, I think, 4 appendices, appendix A, B, C, D. The only one you need to know is appendix A after chapter 10. That appendix talks about time value of money. It's probably one of the most foundational concepts about anything in accounting and finance. And we will come back to this concept when when we are taking managerial accounting. You will have to recall this concept when you take any finance courses. TVM, time value of money. Okay, so long-term liabilities. A promise to be fulfilled in more than a year. These are the types. We're only going to cover bonds and notes payable. So this is an example of a bond. So this company, Dow Chemical, the Dow Chemical company, is borrowing money. They're issuing this instrument for $10,000. This is the annual rate. We will call this stated rate, or bond rate. This rate is fixed, it doesn't change. And then there is a maturity date right here for the bond. The bonds are usually long-term. They could last for 3 years, 5 years, 10 years, 20 years, 30 years. So they're long-term bonds. We will assume with the bond that interest will be paid always semi-annually at a stated rate. So the stated rate then has to be divided in 2 to figure out a semi-annual payment. So we will assume that every bond pays interest to the bondholders twice a year. Also, the principal or par value or face value is whatever is stated on the bond, $10,000. So principal, par value, face value is all the same. It's the same term. And the maturity date, 3 years from now, 5 years from now, 20 years from now is when the bond matures. Now, these are different types of bonds you need to be familiar with. Debentures are bonds issued usually by governments, by like US government. So the US government borrows money by issuing bonds. They're called treasury bills. They're issued by the US Treasury. The US government borrows money when we fall short. Our revenues are shorter than our expenditures. So we need to, we need to borrow more money. Who can buy these bonds? Anybody. People, individuals, foreign governments, pension funds, investment firms. So the US government usually issues unsecured bonds. Businesses usually have to issue secured bonds, meaning there is some kind of asset, collateral that secures the amount of the bond. Junk bonds, you can read on them. Term bond is the one that will mature at once. A lot of bonds are serial in nature. They're serial bonds, so that the company does not have to pay back the full amount at once. They mature in installments. Apple issues bonds for billions of dollars, and some of these bonds will mature in 3 years, some in 5 years, some in 10 years, and so on and so forth, called serial bonds. Callable bonds, you will have to use this feature. Sometimes the bond has a feature, the issuer of the bond, the company that is borrowing the money. It's called the call, where the company can call and retire the bond before it matures. Usually then the issuer, the company borrowing the money, has to pay some kind of penalty or fee to the bondholders, and companies are willing to do it if the interest rates change. Convertible bonds could be transferred into shares of common stock or commodities such as oil or natural gas. So a bondholder can either get the money back or can get shares of common stock. All of the bonds right now are registered bonds. So these are advantages of bonds and disadvantages, right? Bonds are different from stock. Bondholders are not owners. They do not own the company. But then the company has to pay them interest, right? But that interest is tax deductible. So these are some of the advantages and disadvantages. So basics of bonds. In this chapter, we are the corporation or the government that issues bonds. Who buys them? Investors, right? They could be bought at the stock exchanges, through NASDAQ or through New York Stock Exchange. They're traded just like stocks. And it could be individuals, it could be mutual funds, it could be pension funds, it could be institutional investors. So we borrow money. Bondholders lend us money. We get the money today. Then every 6 months, we have to pay interest based on the contract rate or stated rate, fixed rate. So we will talk about market rate, which changes all the time. The fixed or contract or stated rate, that's the rate from the bond. That doesn't change. And so we divide it into two to get a semi-annual payment. And then at maturity, we pay the face value. Whatever we borrowed, we give it back to the investors, right? And guys, we have to pay this interest because we're borrowing money today, and that's the concept of time value of money. I'm borrowing $1 million today. I will pay $1 million in 5 years, but $1 million in 5 years will be worth less because of inflation, always. So in addition to just the face value, investors require me to pay interest because otherwise it doesn't make sense for them to lend me money. So bond issuances. When the bond is issued and the bond stated rate is above market rate. So we set our bond to be 6% at the time when market rate was 6%. But then it takes time to underwrite the bond and go through all the paperwork and filing. And finally, when we actually start selling our bonds, my stated rate remains at 6%. But the market rate right now went down for whatever reason, and it's 5%. So then my bond is very attractive. I'm offering a rate that is higher than the market. What's the market rate? Well, it's the kind of average rate that similar investments are paying at the market, right? It changes all the time. So it's somewhat an abstract idea. So if my bond is 6%, and it's above market rate, which is 5%, I can actually sell my bond at a premium. So if the face value of the bond says $1 million, I can actually get more than $1 million. I can get 100,000 more or 200,000 more. It depends on the situation and interest rates, because everybody wants my bond. I'm offering better rates, so there is more demand than supply. So I can actually get a little bit more cash. Sometimes not a little bit. I can get more cash in the beginning when I issue the bond. When my stated rate is same as the market rate, which is never true, then I sell bond at the par value, right? If it says the face value is $1 million, then I will get $1 million in cash. Or, so when my stated rate is 6%, but the market rate right now went up, so it's now 8%. Right? So nobody wants my bonds. When my stated rate is below market rate, I'm offering lower rate, and I cannot change my rate, right? It's already fixed. Then nobody wants my bond. So I have more supply than demand, and then I have to sell my bond at a discount. My face value of a bond says $1 million, but I would have to get less in cash than that. I would have to get 900,000, 946,000, even though at maturity I have to pay $1 million, because otherwise nobody will want my bond. So we will go through those examples. Here is an example of issuing bonds at par. I want to remind you, my rate, the bond's rate, is the same as market rate. So the bond we're issuing has a $1 million par value. 10% annual, right? 10% interest rate. We pay interest twice a year, so every 6 months we'll pay 5%, and it matures in 5 years. So since I'm issuing at par, it means that the stated rate is equal to the market rate. So I just get par value. This is my entry: debit cash, credit bonds payable. We get $1 million today, January 1st, 2016. So in December 31st, 2020, in 5 years, we have to pay back $1 million. But we also, every 6 months, we have to pay interest. And that interest, here is the calculation. Par value, $1 million, 10%, half a year, 50,000. How many times will I make this payment? Well, it's a 5-year bond, and I will pay twice a year. So I will make 10 of these payments. So every June and every December, I will pay $50,000. Look at the accounts. We debit the bond interest expense, we credit cash. We send interest, we send checks, or make electronic transfers to our bond holders. So in total, I will pay $500,000 in interest, right? 50,000 every 6 months, and it will happen 10 times because it's a 5-year bond. Twice a year. So in total, I will pay $500,000. And then at maturity, I will pay back $1 million. Look at this transaction. It's a flip of the first journal transaction. I pay off, I extinguish the debt, bonds payable goes down, debit, cash goes down, credit. Now, this is a situation when we have with you, when we issue bonds at a discount. I want to remind you that my rate is now lower than the market rate. Nobody wants our bonds, right? So this will be mostly given to you, bond issued at 92.6405. If it says anything below 100, it means that's a percent, that bonds are issued at a discount. Right? So what you do to figure out cash, you multiply par value by this percentage. So if it's below 100%, it means the bonds are issued at a discount. If it's above 100%, like it would say, bond is issued at 102. That means 1 or 2% of par value. So it's issued at a premium. Again, my rate is below the market rate. Nobody wants my bonds unless I sell it at a discount. Again, what are my cash proceeds? Million multiplied by this percentage. So I will get $926,405 instead of $1 million. But I owe $1 million. Now, this slide actually shows to you, this is the time value of money, it's Appendix B. It shows to you how this amount is calculated, this percentage. I will go back to it later. Okay, so we're issuing a bond at $926,405. We owe $1 million. So the difference is this new account called discount on bonds payable. This is a contra liability, discount on bonds payable. It's a discount, it's an expense to be recognized in the future period. It's my loss. But because the bond lasts for 5 years, it wouldn't be fair to say it's an expense, right? And just recognize it now. So what we're going to do with it, it's kind of similar to depreciation in the concept. We're going to take this discount and we're going to spread it over all future periods, right? We're going to divide it over how many periods, how many times we're paying interest. And we're going to pay interest 10 times, right? So we're going to take our discount on bonds payable, $73,595, and we're going to divide it by 10 periods and round up. So we will recognize 1/10 of this discount as an expense every time we pay interest. This is an explanation of what carrying value of a bond is. It's similar to book value concept from chapter 8. So your face value of the bond minus the discount gives you the carrying value. So this discount, we're going to start amortizing. So after each period, this discount will decrease. So the carrying value will increase. At maturity, this carrying value will go up to $1 million. Okay, so here is my journal entry for interest payment with the bond with a discount. The cash amount does not change, right? It's $50,000, a million multiplied by 5%. But I'm taking 1/10 of the discount. Discount is this account is a contra liability, right? So it's plus minus, and I'm going to minus it. So the total amount of a discount goes down. When I credit it by 7,360, this total goes down, and it increases my expense. So look at bond interest expense. I'm paying only 50K in cash, but I am amortizing 1/10. In addition to the bond interest, I'm also amortizing 1/10 of this discount, and I'm adding it right here. So my bond interest expense is higher than my cash payment. And so you will have to prepare the so-called straight line amortization of a bond discount. Straight line amortization means that my discount amortization is the same, except for the last period because of rounding up. So my cash payment is 50,000 every period, 10 times, every 6 months. The debit to bond interest expense is the same. The credit to the discount is the same. Look what happens to the balance of discount. This is discount on bonds payable. So as I said, I amortize it, so the balance goes down. When the balance goes down, carrying value goes up. Carrying value is your par value minus discount. Par value is a million. So when discount decreases, carrying value increases. So at maturity, I fully amortized, expensed out the discount. So the carrying value is now equal to par value. We pay back $1 million. Our books are taken care of. So this is important. You will have to prepare the straight line amortization. In reality, companies use a so-called effective rate amortization that is a little different and more realistic, but I'm not going to cover it in this chapter. It's in the appendix, and you study that in your finance courses and intermediate accounting courses. Well, similar story with the with issuing a bond with premium. So right here, guys, our bond stated rate is higher, right? It's a different story. Now everybody wants our bond. Our rate is 10%, market rate is only 8%. So I can sell right here, this is given to you. I can sell my bond at a premium. This is the percent. So instead of $1 million in cash, when I issue bonds, I multiply, I get 1,081,145 above par. So I'm going to get this premium, which is like revenue, but it wouldn't be fair. It would be wrong according to GAAP to recognize this entire revenue in one period. So we're going to spread this revenue over the future life of the bond. We're going to amortize this premium, and what this premium will do over 10 periods, what this premium will do, it will decrease the bond interest expense. We're still going to be paying $50,000 in interest, but my bond interest expense now going to be less than $50,000. So here we are, we issue bond, we get cash. Premium is an interesting account. It's called adjunct liability. So it's the opposite of contra. Adjunct liability depends on the main account. They never travel separately, but the signs are the same. So the premium on bonds has the same signs as bonds payable. It's minus plus. So when I credit it, I increase it. When we're going to debit it, amortize it, this premium will go down. Our goal is to amortize this amount, get rid of it throughout the life of the bond. So the bond's carrying value right now is 1,081,145. Every time I amortize the premium, the carrying value will go down, and at maturity it will be equal to million. So carrying value of the bond, we take 81,145 divided by 10 periods. That's how many times we pay interest. We round up, we get 8,115. So every time we pay interest, look what we do. Cash does not change, 50,000. We pay interest of 50K. But now my premium, it's a revenue, right? well, it's not revenue, it's like revenue. It decreases the amount of the bond interest expense. When I debit premium, premium goes down, the total of the premium, and it decreases the bond interest. So the bond interest expense is 50,000 minus 18,115 equals to 41,885. And we repeat it again. Interest payment cash does not change. Bond interest expense does not change. Premium amortization doesn't change. But look what happens with total premium. Every time I amortize it, premium goes down. Carrying value is a million plus premium. So for the discount, carrying value is a million of par value minus the discount. Here it's 1 million par value plus premium. So when premium goes down, carrying value goes down, right? So we start above par, at maturity it's equal to par, we paid off, we close everything in the books. Okay, so effective interest I'm not going to cover. Now, how do they come up with this idea of 108.1145%, or in the previous example 92.6405%? Well, this is how they do it. This is time value of money. We have to figure out present value of the discount bond. We're using Appendix B. So we have two types of cash flows here. So the investor right now is thinking, well, I have to pay you back, us back, right? The investor is thinking, I have to pay $1 million in 5 years, right? So, well, how much is this 1 million is worth today? So what we do, we use present value tables. You will find them in your textbook in Appendix B at the end of the book. Not after this chapter, but at the end of the book, there are tables. It's table B1 and B3. We're not going to use B2 and B4. If I look at the page numbers in your textbook, let me see. So Appendix B, I have page numbers B-10, B-11. So those, that's almost at the end of the book. So we're using table B1. It's called the present value of $1. And we'll look up for periods. So how many periods is our bond? 10 periods. We pay interest 10 periods. 10 periods. Bond life, 5 years multiplied by 2. Guys, we will always use market rate. Whenever you look in the tables, we do not use the bonds rate. We do not use the stated rate. We're using the market rate. So I want to remind you here, the market rate is 12%. So the stated rate we use to calculate the interest amount, right? 10% per year, half a year, $50,000. For the tables, we're going to use half of the market rate. So 12% divided by 2 is equal to 6. Look it up. 10 periods, rate 6%, intersected, you get this present value factor. So what it means, if I invest today 56 cents and keep it in the investment for 10 periods, and that investment is paying me 6%, it will grow to be $1, right? But we have an investment that will have $1 million. So I multiply, so that's a future value, right? In 5 years, in 10 periods, we will get back our $1 million. Well, we multiply it by this factor, and this is the present value, right? Present value. So today, this $1 million is only worth $558 and $400. Or if I invest $558 and $558,400 today, I keep it in the investment for 5 years. The investment will pay interest twice a year and will be reinvested in the investment at 6% per 6 months. It will grow to be $1 million. So the investor says, well, you will give me $1 million 5 years from now, but right now it's worth this amount, $558,400. Well, also you're gonna pay us $50,000, right, in interest. And this is called an annuity. $1 million is a lump sum. It's a one payment. But $50,000 is an equal amount that comes in, to me as an investor from you, from the bond issuer, every 6 months. So we're going to use table B3 on the next page, B3. And what we're going to look up, we're going to use the same factors. It's an annuity. There are 10 periods, and it's paying 6%, which is half of the market rate. We get this factor. And then, so I will get paid $50,000 10 times in the future, every 6 months. So I will get, multiply by 10 times, cannot write well, equals to $500,000, right? So I'll get $500,000. But how much does this cash flow, future payments, this annuity, how much is it worth today? I take the factor, I multiply by 50,000. This is what it's worth. You will pay me $500,000, but that's in the future. Today it's worth only $368 and $5. I add them together. This is what I get. $926,405. How much is this bond worth today? $926,405. So most of your problems will give you this percentage, right? You don't have to worry about it. Sometimes when you're asked, like on the exam, one of the problems will ask you to calculate the price of bond. How is this bond price calculated? Well, we went through this. This is the pricing of the bond. This is how we calculate it. Okay, so I'm going forward. So let me skip the effective interest rate. Guys, the bond retirement can get confusing. At maturity, it's very easy, right? We just pay off the bond par value. But sometimes the bond could be retired before maturity. And here is an example of the problem. Here is the explanation. Usually, we will also have a gain or a loss. So go over this. I'm not going to spend time here, but you will have a homework problem and some multiple choices here. Here's another example of bond retirement before maturity. For the last part of this chapter deals with notes payable. These are your mortgages. And again, the slides go over it, how to calculate. When you borrow money, for example, you have an auto loan, your payment, here they say once a year, but usually we pay monthly. And our monthly payment for our car loan or our mortgage is the same, right? It's the same payment. You're paying $1,700 every month. But within that payment, there is a portion that pays off principal and the portion that pays off interest. In the early stages of payments, a lot of your payment is actually interest. That's the way of banks protecting itself. And the longer you pay, the higher your principal amount is going to be, and the portion of interest will become less and less. So the chapter teaches you right here, and again, you're using formulas, and you're using the principal divided by present value of annuity factor. Because if you think about those payments, they're like annuities, right? I'm making a payment, the same payment all the time. So they show you how to calculate that cash payment. How do you come up with that equal payment every period, every month, or every year? So you will go over that. And the last ratio here is called debt to equity ratio. This is the formula. We take total liabilities, we divide by total equity. So for example, if debt to equity ratio is 3.1, it means for every dollar of equity, the company has $3.10 of liability, which is not good. So this is one of those ratios that we want to be lower. The lower, the better, If this ratio is lower right here, it means that back in 2010, for every dollar of equity, we had $1.70 of liabilities. Now it's almost doubled, right? For every dollar of equity, we have over $3 of liabilities, which means we've been borrowing more and not paying off. So this is the factor that shows the company's ability to meet its, how much does the company rely on debt? The company's solvency, that's what it shows. So the company with the higher debt to equity ratio has much more reliance on debt, and then there is a risk of investing in the company or giving a loan to the company because they already have a lot of debt. Okay, so that's chapter 11. Thank you. I'm sorry, chapter 10.